Welcome. Today we're going to be talking about setting up your group of property companies. Hi, I'm Kimberly Shapcott, qualified chartered accountant with over 15 years experience, property investor and entrepreneur. Let's talk about setting up your property group of companies. Why is it important? What are the benefits to actually having a group of property companies? Why would I not just have one company that does everything? Now, one of the key things is the risk factor. And that is one of the reasons you might have a few different strategies that you're working on in your property ventures. You might be doing new builds, you might be doing HMOs, you might be doing buy-to-lets, you might be doing sourcing, you might be doing flips, and there's quite a few other options available that you might be looking at doing. Now, do you want all of those differing risks in the same company? Now, if you're only doing one or two things and you're not doing them regularly, then you might go, it's not a problem. But if some of these things are ones you're going to be doing regularly or frequently, then I'd definitely be thinking about setting up a group of companies. And there are a couple of reasons why this might be a great option for you. So let's start with some of those reasons and then let's crack on with the actual practical side of things of how you go about setting up your group of companies. One of the great things about setting up your group of companies is a way of collating all of your profits together. So how it works is you have one holding company and lots of different subsidiaries. Now, I'd say not too many subsidiaries because we don't want to go company crazy. But if you've got a couple, you can then separate out the relevant risks to different companies. Now, as you make a profit in each different company, you will then move that profit up into the holding company. And that is really great because then everything for you is all in one place. And it makes planning your personal tax arrangements a lot better for you. So rather than having this company and that company and another one over here, where you've got to go, I have a little from this one, a little from that one, a little from that one. What you actually end up doing is moving all of it to your one company and then deciding how much you want to take out that one company rather than having to decide what you're taking out from several different companies. Now, one of the issues to mention about this, however, is there can be lending difficulties because some of the lenders are not as savvy in terms of structuring of companies and they see it as quite a complex method of setting things up. Now, it will depend on the lender, it will depend on what you're trying to do, it will depend on the type of project you're doing and how far into your journey within property and your investing ventures you are. This can be seen as complex. Now, I tend to look at some of these sides of things as we keep the structure as simple as possible, but more complex to make sure we fit everything together. But speak to your finance broker as they will be able to give you more guidance on the finance side of things to make sure that any structure you're looking at is going to still work from a lending perspective. Because you don't want to do one thing for tax purposes to find it doesn't work from your lending perspective. A few other points to note with a property group that can be really great are that there are certain tax exemptions and intra-group transfers that you can do. So if you're looking at things like title splitting and moving things around to different companies in your group, there are quite a few exemptions for tax purposes that work really nicely, which you wouldn't be able to do if you just own things in different companies. Another point to mention is if you do find that you are making losses in one of your group companies, within a group structure, you are able to move those losses around. So overall, you can make sure that you are not paying tax in one profitable company, but making losses in another that you can't use anywhere, which can be great when you're doing new ventures or you're getting started and doing things in different entities. This can only happen when you are within a group. So that is one of the great benefits, that you don't find you're paying tax in one place but not paying tax in another and you wish you could net it all off. In a group, there is definitely some benefits there to keeping your tax bills as low as possible. Another thing to mention within a group is it can work really well with joint venture companies. So if you are working with other people and you've got a 50-50 joint venture company, you can set up that company to be owned by your holding company, and having your holding company own it means when your business partner wants to take some money out of the company, that's not a problem for you. It has no impact on your tax position at all. So let's just use some numbers as an example. That you've made 10,000 in the year and you both want to take 5,000 out of that company. You'll take that 5,000 out and put it into your holding company, and in doing that, that money just goes up to your holding company. There's no tax consequences because it would potentially be coming as a dividend from your joint venture company. And then you'd have 5,000 cash sitting in your holding company, hopefully to use somewhere else in the group, or if you want to take that money out, you can take that money out in the most tax efficient manner. And check out the video of taking money out of your property company to find out what those options are. So let's move on to how you go about setting up the structure of your group. It's not particularly different to how you set up any other company. The only real difference is, rather than you owning the shares in all of the companies, you will own the shareholdings in your holding company. Now, this is the main company that you have. Now, the key difference here is that you're going to be using a specific SIC code for your holding company, which is 64209, activities of other holding companies not categorised elsewhere. And in having this category, it means that it shows that it's just a holding company. Now, from that point of view, you are going to be the shareholders, and in my other video about setting up a property company, it can take you through the different options for your shareholdings, such as alphabet shares, such as bringing in other individuals within your family. So check that out to make sure that you're setting up the shareholdings in the right way. Once you've set up your shareholdings, that's great. Everything is now set up in the holding company. Now for your other companies. Now, this may be joint venture companies, this may be a buy-to-let hold company, this might be a development or a new build company. The key thing for all of those entities, those companies, is that you form the company as you would normally. However, when you set it up, the shareholder of that company is your holding company, and you always have it as 100% holding company owned. The only exception is when you're doing a joint venture where you'll have your other business partner as the shareholder of those other shares. Now that might be that they've got a holding company, so you've got two holding companies owning the joint venture company, or it may be them as an individual who owns the other half or other third or whatever proportion of that joint venture company. Now, that hopefully ties all of the shareholding side of things together. The other question is who should be the directors. And that really depends who you want to be the directors. From a lending point of view, they tend to want the directors on the lending application. So that might have an impact if you want specific people to be a director who might be mortgageable, who the lenders might be happier with. Or you could have all the shareholders as your directors. I'd probably suggest you don't necessarily have everyone if there is a number of you. If there's only 2 of you, it might be not a problem to have both of you as directors. If there's 10 of you, you probably don't all 10 need to be directors of the company. You can still be involved, but you don't actually need to have the formal position of director if there is no specific need to. There's no limit to how many companies the holding company can own. The only key thing I'd probably mention is you don't want to have too many companies because you do have the admin of running a company. So there will be bank accounts for each company. There will be accounts that need to be filed with Companies House for each company. There will be forms to send into HM Revenue and Customs for each company. So as you can see, it's more the admin burden that I'm suggesting. You don't want to have 20 companies for the sake of having 20 companies, unless you've got 20 companies because you've got 19 joint ventures. that you needed to separate out with different people. Ideally, you maybe want a group with a couple of companies, 2, 3, 4 companies, which means it's easier to keep control of what's happening. The key thing for considering whether you need a separate company is probably the risk factors. So just consider what the risks are and who is involved in those projects to make a decision on what is best for you and your group of property companies. If you have any other questions about your group of property companies or any further information you would like me to share, please do leave a comment in the box below. Well, hopefully today you've discovered why setting up a group of property companies might work for you. If you have any questions, please do leave them in the comments below. I'd love to hear from you. Thanks for watching today. Please click like on the video and please do subscribe to the channel. If you've got any questions about any other property related tax or accountancy topics, then please do leave a comment in the box below. Let's make tax less taxing.